Welcome to this deep dive into the recent earnings call from Delek US Holdings, ticker DK. We're looking at a report the market had been, well, really bracing for, and what we got was, frankly, a shockwave.
Absolutely. And the stock response, it tells the story, doesn't it? Real robust follow-through, trading higher, huge volume.
Yeah, it wasn't just a slight beat. This felt like a comprehensive beat, shattering expectations. So we're here to give you the shortcut, really, to understanding what drove that massive positive reaction.
Right. Our mission today, it's pretty straightforward. We want to synthesize the key points, show how Delek tackled the two big overhangs on the stock. First, getting financial clarity on those SRE grants the regulatory risks.
The small refinery exemptions, yeah.
Exactly. And second, showing the power of their own internal efforts.
Yeah.
The Enterprise Optimization Plan, the EOP.
Yeah.
This report, fundamentally, it's about execution and how that's accelerating cash flow.
Okay, let's jump straight into those headline numbers because they were pretty shocking. Adjusted earnings per share, $7.13.
$7.13.
Yeah, and remember, consensus estimates were down around, $0.28? So, that gap is just enormous, really speaks to the surprise factor.
It's a staggering difference. Revenue is also solid, ahead of expectations, came in at $2.887 billion, beat the consensus of about $2.71 billion.
Right.
But, and this is key, to get the real operational picture, you have to look past that huge headline EPS number. It was significantly boosted by a non-operating benefit.
Okay, what was that?
That was the $280.8 million they recognized, related to those historical small refinery exemptions, the SREs we mentioned.
Got it. So a big one-time item there. If we strip that out, that regulatory windfall, how did the operations look on their own?
Still very strong. Even on that normalized basis, adjusted EPS was $1.52. And the adjusted EBITDA, excluding those SRE items, hit $318.6 million. So yeah, these adjusted figures, they really show the underlying strength. That's the foundation here.
And that foundation, it seems, rests heavily on this self-help story, right? The Enterprise Optimization Plan, the EOP.
Exactly. CEO Avigal Soreq, he framed it really well on the call. He emphasized that management sees EOP as a, quote, lifestyle. It's about continuous structural improvement, not just some temporary cost cut.
And the market loved that they didn't just meet their EOP goals, they actually raised them again.
That's right, again. The annual run rate cash flow improvement target for EOP, it's now at least $180 million. That's up quite a bit from the prior midpoint, which was $150 million.
And crucially, this isn't just talk, right? They showed progress.
Absolutely. They pointed out they already recognized about $60 million these improvements just in Q3 alone. So tangible results happening now.
And where do those benefits really show up? Refining must have been huge.
Oh, definitely. Refining adjusted EBITDA was $696.9 million. Compare that to just $10.2 million in the same quarter last year. Now, obviously, the macro environment helped.
Sure, crack spreads were up big.
Right, but the EOP, that's what let them capture the maximum benefit from that strong backdrop.
Okay, let's dig into that structural claim a bit. You mentioned the supply and marketing segment contributed about $130 million this quarter. Management said, $40 million of that was directly from EOP, things like contracts, market optionality.
Yeah, about $40 million.
So help us understand, what makes that $40 million truly structural? Is it just a better negotiation this quarter, or is it something deeper, like a system change?
That's the critical question, isn't it? They talked about exiting less profitable markets, entering new ones. That's the optionality piece. But structurally, they also pointed to real changes in their logistics and supply chain systems.
Okay.
Moving feedstocks and products more efficiently, optimizing routes between refineries and terminals.
Yeah.
It wasn't just, getting a better price on a contract for a few months. It's about implementing systems that inherently cut down on friction, transport costs, time costs. That's why they believe that $40 million is sticky. It's meant to be a permanent efficiency gain.
Okay, that makes sense. A permanent shift. That's crucial. Now, let's pivot to the other huge piece of news, the SRE clarity. Finally, this unlocks a massive pile of cash, doesn't it?
It really does. The regulatory uncertainty that's hung over them for years, it's finally lifted. The EPA approved several pending SRE petitions covering a wide span 2019 right through 2024.
So the clarity is great, but what does it mean in dollars and cents for investors?
That's the bottom line. The company expects to get about $400 million in cash proceeds. And that's specifically from monetizing the SREs granted for 2023 and 2024.
Okay, $400 million cash. How does that actually work? They just get a check from the EPA?
Not quite. So SREs waive the requirement to comply with the renewable fuel standard. That means they didn't have to buy these costly compliance credits called renewable identification numbers, or RINs.
Ah, the infamous RINs.
The very same. So since DK didn't have to buy them for those years, they now have banked RINs they can sell, or they simply benefit from the cash they didn't have to spend. The key point is the timing. They expect this $400 million monetization, the actual cash, hitting their account over the next 6 to 9 months.
6 to 9 months. That's a pretty substantial near-term cash injection.
Exactly.
Now, that clarity immediately begs the question about the future, right? Are SREs sustainable? Management seemed pretty confident.
Very confident. They took a strong stance, explicitly saying they expect to receive 100% of SRE exemptions for 2025.
100%. That sounds bold, especially given all the political back and forth and court cases around RINs. Is that confidence truly warranted, or is it more like signaling to the market?
Well, it's definitely aggressive signaling, no doubt.
Yeah.
But they root it in their specific legal interpretation. They argue court decisions, and the underlying law actually support their position. And they believe this legal standing will transcend the current administration, whatever the political winds are. Essentially, they're telling investors, look, we think we have a structural legal advantage here, and we don't see it disappearing.
Right. Whether the market fully buys that 100% number long term is maybe another story, but it gives a clear framework for now.
Precisely. It sets an expectation.
Okay, let's switch gears slightly. Let's talk about the sum of the parts angle, specifically focusing on Delek Logistics, DKL. This matters because management keeps highlighting DKL as this stable, potentially higher multiple business, separate from the more volatile refining side.
And DKL is certainly playing its part, delivering that stable growth story. They actually raised their own guidance, too. Full year 2025 adjusted EBITDA for DKL is now expected between $500 million and $520 million.
So pushing into the top half of their prior range.
Exactly, comfortably in the top half.
And what's driving that momentum at DKL? Is it just Permian growth?
Permian expansion is a big piece, yes. And also continued progress on what they call the economic separation from DK. But what's really interesting operationally is their focus on Permian sour gas.
Sour gas. Okay, tell us more about that opportunity.
So, management feels they were sort of ahead of the curve in developing solutions for handling sour gas with higher sulfur content in the Permian. They specifically mentioned the successful startup of their Libby 2 plant.
Right.
And an accelerated program to offer a full sour gas solution in the Delaware Basin. This involves gathering, treating it, injection, processing, the whole package. It's a crucial capability.
Why is it so crucial now?
Because as Permian drilling continues, especially in certain areas, dealing with sour gas becomes more important. Having that infrastructure positions DKL to capture more volume, more growth, driving, potentially best-in-class EBITDA growth for a midstream player in that region.
Okay, let's put all this great company-specific news into the broader context. The refining segment obviously had a good macro tailwind. How much did the market help?
It definitely helped. Gulf Coast benchmark crack spreads, that key refining profit metric, were up roughly 46.8% year over year. That's a significant tailwind.
A huge lift.
Yeah. But as we discussed with the EOP, Delek wasn't just riding the wave. They seem to have maximized their capture of that improved environment through better execution.
And that strong performance allows for it.
Disciplined capital allocation. That's the message. Over the last 12 months, the company actually claimed the highest total return yield, that's buybacks plus dividends, among all their refining peers.
Okay, that's a strong claim.
It is. And in Q3 alone, they paid the regular dividend, 0.255 per share, and also bought back about $15 million in stock. So consistently returning cash.
And the balance sheet. Can it handle this incoming SRE cash?
Looks like it. Standalone net debt, so excluding DKL's debt, actually decreased slightly. It's down to around $265 million. So a pretty solid foundation is there, ready for that cash infusion.
Which perfectly sets up the key catalyst for investors to watch over the next, say, 2 quarters.
Yeah, the catalysts are pretty clear now. First, the timing and the exact amount of those $400 million SRE cash receipts. Does it come closer to 6 months or 9 months?
Right. Speed matters.
Speed absolutely matters. Second, further EOP milestones. Can they keep finding savings and push that run rate even beyond the new $180 million target?
Keep that lifestyle going.
Exactly. And third, DKL delivering within its newly raised guidance range, that $500 to $520 million for 2025 EBITDA. If those three pieces fall into place,
Then the recent stock re-rating could have more room to run.
potentially, yes, it could accelerate things quickly.
All right, we've covered the numbers, the structural improvements via EOP, the SRE cash windfall, the DKL growth story. We know hundreds of millions are supposed to hit the balance sheet soon. So let's shift gears into that perhaps more speculative territory. It's time for our segment. This is not financial advice.
And right on cue, we absolutely must state the full and required disclaimer. This discussion is purely for informational and entertainment purposes. We are not registered investment advisors.
That's right.
Any ideas discussed here are theoretical, potentially high risk, and should definitely not be taken as personalized financial advice. Please, always consult with a qualified professional financial advisor before making any investment decisions.
Okay, disclaimer delivered. Now let's get into it. Pitch us an outrageous but plausible trade idea, something reflecting this bullish mood, and importantly, that expected wave of cash.
Okay, so given the stock's really powerful momentum lately, you mean triple-digit gains year-to-date before this report even, and management's stated commitment to disciplined capital allocation,
Right.
the market, even with all its excitement, might still be underestimating the speed of that $400 million SRE cash inflow. Management gave a pretty wide window, right? 6 to 9 months.
Yeah, that's a 3-month range.
Exactly. So the trade idea is what we'll call the SRE cash flow arbitrage bet.
Okay, arbitrage bet. I like it. What's the play?
The play is to buy the stock now, specifically betting that the Treasury team at Delek is better or faster at monetizing those compliance credits, those RINs, than the market currently expects.
So you're betting on the 6-month end of the range, or even sooner.
Or even sooner, potentially.
Yeah.
If that $400 million cash pile lands firmly on the balance sheet early in the next 2 quarters, maybe closer to that 6-month mark, or just inside it, what could that trigger?
An unexpected capital return announcement.
Precisely. An accelerated, maybe unscheduled capital return. Think potentially a large one-off tender offer for shares, or maybe a junky special dividend, announced sooner than anyone's modeling right now.
And that surprise factor would be the catalyst.
Exactly. That rapid deployment of cash ahead of schedule would be a high-impact short-term catalyst. And the argument is that the current stock price, even after this big run, hasn't fully baked in the timing aspect of that cash flow. It's a pure bet on regulatory logistics and corporate execution speed.
Interesting. A bet on speed. Okay, let's wrap this up. To summarize the key themes from this DK report, a really powerful quarter. You had exceptional execution on the EOP, pushing savings targets higher.
You had significant regulatory clarity, finally unlocking that $400 million in near-term cash from the SREs.
And you had accelerating growth from the midstream segment, DKL, raising its own guidance. It really felt like the blueprint quarter investors were waiting for to kind of re-underwrite the whole story.
Absolutely. The core narrative, it's clearly shifted. It's moved away from just risk mitigation towards cash generation and proving out those structural improvements. But there's always a but.
Always.
The final thought, the thing for you to really mull over is this. Management has pushed these EOP savings up past $180 million annually, and they claim they're largely structural, permanent.
Right. The lifestyle.
The lifestyle. How durable will those $180 million plus improvements truly prove to be if, or perhaps when, the macro environment normalizes? Specifically, if those Gulf Coast crack spreads eventually drift back down towards more historical averages. That's the key question for the longer term. And digging into that is the knowledge you need to start exploring next.
A great question to leave things on. Thank you for joining us for this deep dive into the Delek US Holdings earnings report. We hope you feel thoroughly well informed and ready to continue your own exploration.